I'm JD Frost, and welcome to the Accountability Show. I really appreciate you tuning in. And as always, please turn your notifications on, comment below, like this episode, like other episodes. I would really appreciate your support, and make sure you subscribe to the YouTube channel. But we have been talking about cash flow statements over the last 3 weeks, and we talk about the how, the what, the why, the how, and then we have an actual example that we want to show you of how to read cash flow statements and each one of these different points of foundation for your accounting in your business. So we've been talking about balance sheets, we've been discussing check spread templates, we've been talking about entity structuring, but once you get all those things set up, the main thing that you need to pay attention to and understand how to read a cash flow statement in your business. Lots of business owners, even myself, we run our businesses off of just the amount of cash that's in our bank account from time to time. It happens. It's okay. But the best way to manage your business is through a cash flow statement, because that is going to allow you to know where your cash is going, what adjustments you need to make in the future. And there's a couple different ways to create a cash flow statement. One of the main ways that we create a cash flow statement is called the indirect method, and that's what we talked about in the previous episodes. Is the indirect method starts with net income. So I've got an example of Paul's Guitar Shop here. It's a cash flow statement. I think we just found this on the internet, didn't we? Yeah, so we just found this on the internet, and this is a cash flow statement. It's pretty basic that I want to go through how to read this so that you can actually see what we've been talking about. So cash flow statement's broken down into 3 different categories. You've got your operating activities, you have your investing activities, and I think this is going to underline, yeah, there we go, operating activities, you got your investing activities, and you have financing activities. This is so awesome. Like, you're going to record this screen. Nice. Love this. Feels so professional. Anyways, I digress. Operating activities, investing activities, financing activities. In the previous episodes, we went down into detail about which one of these activities there really is. And operating activities, as you can see from this actual example, is your accounts receivable, your inventory, prepaid expenses, accounts payable, accrued expenses. Those are pretty basic operating activities of a business. Now, remember, a cash flow statement is a change in the balance sheet accounts from one period to the next. So the way that you're able to come up with the numbers that are on this statement is by comparing balance sheets from one period to the next period. So in this example, when we are dealing with the indirect method, we are going to start with net income. Net income is the beginning point of any cash flow statement on the indirect method. The net income was a positive $12,950. Now, depreciation, and this is getting really technical right now, but it's important for you to understand. Depreciation is what we call a non-cash expense. Any non-cash expenses need to be added back to net income, because on the income statement, if you watch our previous episodes, on the income statement, depreciation is an expense. It reduces your gross revenue, which reduces your net income in the business. But on the cash flow statement, it's a non-cash expense. So when you say non-cash expenses, or when I say non-cash expenses to you, that means that you have to add that back because it wasn't really cash that was used. Does that make sense to you, Meg? No?
So you have to add the cash back that was used?
You have to add the depreciation because it didn't use cash in order to get to that net income number. Okay. So another way to say that is, does that make sense to you, Jay? I like this interactiveness. So another way to say it is, when you're creating an expense called depreciation, you don't have to spend money to depreciate an asset.
Yes.
That's why it's a non-cash expense.
But that still goes on your cash flow statement?
It goes on your cash flow statement because when we're starting from net income, which net income was created because we depreciated an asset, we have to add back that number because we didn't use cash to actually depreciate that asset.
Okay.
It's a hard concept to understand. That's why I'm trying, like, your marketing, no accounting. I don't know what you're doing right now. I don't know if you're an accountant or if you are a marketer or business owner, but it's a difficult concept. So when you're taking this net income number right here and you're adding back the depreciation, that is adding back the cash. Because you didn't use cash to get to the net income number. Because what we're trying to do with the cash flow statement is we're trying to get down to this number right here that says ending cash balance down at the very bottom. To get to your actual cash, you have to account for the cash that was used. And we didn't use cash in order to generate a depreciable expense. So we have to add it back. Since that net income was basically income minus depreciation, that means we have to add it back to get to what our actual cash that was used. Are you sure? Is it light going off now? Cool. So then you have increase and decrease in current assets. This is really important. If you understand what's going on in this cash flow statement, you are going to understand every decision you make and what that is going to do to your cash. It's very, very important, and something that most business owners aren't thinking about, but the most successful business owners do. They understand when somebody comes in their office and says, hey, can we go invest in a copier machine? Okay, well, are we going to pay cash for that copier machine, or are we going to lease that copier machine? Well, if I want to conserve more cash, I'm going to lease that copier machine because I'm not going to have to pay for it all up front. I'm going to pay for it over time. So that's a decision that is going to limit my cash flow over a period of time. Depending on how long of a lease that is, that will determine whether or not it's going to be a $500 a month payment or an $800 a month payment or a $250 a month payment. But nonetheless, your decision is going to adjust your cash flow over a period of time. Now, if you decide to go ahead and pay for that copier all up front, that could be a $12,000 decision right then and there. It's important for you to understand how decisions affect cash flow in your business. So increase and decrease in current assets, accounts receivable. If your accounts receivable, remember in previous episodes, if your assets increased, your cash decreases. So we had a negative $300 in this example of cash was used. So that means that our receivables increased by $300. Okay? The balance between receivables at the end of 2018 and the end of 2019, that balance increased. So that's a decrease in cash. If we had collected accounts receivable, if our number had decreased from 18 to 19, that means we collected, that would be an increase in cash. Our inventory went down $39,800. Inventory went down, we had a decrease in cash from inventory. So a decrease in cash in inventory means inventory increased during the year. So anytime you have an asset that is increasing, that is going to be a decrease in cash. Same with prepaid expenses. Now, liabilities is completely opposite. When you have an increase in liabilities, that means you have an increase in cash. And that increase, is from the beginning balance to the ending balance of accounts payable. So on the balance sheet last year, according to this example, we had an increase of cash of $49,000, which means the payables increased in value by $49,000 from last year to this year. So overall, our net cash provided by operating activities was an increase of cash of $24,300. So we added your depreciation, we subtracted accounts receivable, subtracted inventory, subtracted prepaid expenses, added payables, added accrued expenses to come to a net number of $24,300. Okay? Now, cash flow from investing activities. This is basically, for most clients, for most businesses, This is going to relate to investing in fixed assets. So you can see they purchased property and equipment, $101,000. So in this particular example, Paul's Guitar Shop, they might have bought, some furniture, equipment, things that they were going to use over a long period of time, and they paid cash for them. So they spent $101,000. Now, if they had financed that purchase, that would not be in this category. They would not have spent $101,000. They would have only made their first down payment. Maybe it was 10 grand. That would be the amount that was in there. Okay? That's all the investing activities that we have in this example. So just like the assets and operating activities, investing activities, if you are purchasing equipment, you're going to have a decrease in cash. If you're selling equipment, then you're going to have an increase in cash. Very important to remember that. So, cash flow from financing activities. Financing activities basically are loans, payments on loans, distributions to owners. There is payments on lines of credit, as you can see here, or proceeds from lines of credit. So if you have a line of credit that's $100,000 and you have used $0, but you go borrow $50,000 from that, you would have an increase, a proceed from a line of credit that would increase your cash because you took that money from the line and you put it in your bank account. If you paid down your line of credit, payments on your line of credit is going to decrease your cash. Okay? So, when you have proceeds from a long-term debt, proceeds from long-term debt means that you got money. So I bet you in this example, this $99,500 is related to the purchase of that equipment. So they purchased equipment, but they also got a loan for it. So that increased their cash by $99,500. The purchase of the equipment decreased their cash by $101,000. The net effect is only a change of $2,500. That's the only amount of cash that they spent in that purchase. And I bet you that's what that long-term debt has to deal with. So overall financing activities is an increase in cash of $109,500. The net decrease or increase in cash during the year was $32,800. So our beginning cash balance was zero. Right here it says zero. So our ending cash balance is $32,800. Now, that stuff can get really complicated. I'm a CPA. I've been practicing for 15 years, and you can even see as I am talking through it, it's difficult to talk through. It's difficult to explain. This cash flow statement takes most business owners years analyzing it, reviewing it, understanding it, walking through it every single month for them to really be able to start to make decisions of, is that going to increase? Is that decision going to increase or decrease my cash? Today, I decided to take a discounted upfront amount from a client of $20,000. Instead of charging them $24,000 over the course of the year, I'm giving them a discount, paying $20,000 up front. That decision is increasing my cash by 20 grand today. Instead of having a $24,000 receivable, which would cause my assets, my receivables to go up and my cash to go down, I'm deciding to collect today for a discounted amount, which is going to cause my receivables to go down and my cash to go up. Very important decision today because I got payroll coming up next week and I need to make sure that I pay everybody. So it's a benefit to be able to understand how cash flow works in your business and how the decisions that you make every single day affect that cash flow. I hope you enjoyed this episode. I know it was a lot of technical talk, but the devil is in the details. And that's where you're going to be able to distinguish yourself as a business owner and make better decisions in your business, understanding how this cash flows in your business and how it works on this statement. Please make sure to comment below on this episode, like and share the episode, turn on the notifications, subscribe to the channel. I really appreciate it. Next week's episode, we're going to be talking about financing packages and how that can affect these statements that we've been discussing in these previous episodes, the last probably 6 to 8, how they affect your financing package and your ability to go get money, more cash for your business from private investors, from banks, from whoever is interested in making your business cash flow. That's what we're going to be talking about in these next episodes. Thanks so much for joining the Accountability Show, and I really appreciate it.